Hello dear traders, my name is Elizaveta Belugina. I'm the head of analytical department at FPS and I'm very happy to greet you at today's webinar. Today we will discuss the weekly outlook for Forex measures and maybe some metals. We will discuss fundamental and technical stuff, the economic calendar and things we can see from the charts. And by the end of this webinar, we'll sum up the trade ideas we have for this week. So let's begin. Here is our usual agenda. And we start with analyzing the market's positioning, the market sentiment, and we usually do that by studying data from CFTC, Commodity Futures Trading Commission. We don't always have good signals from this data, but I still suggest that you look at this data on the weekly basis, because sometimes there may be interesting insights about the Forex market here. So here we have the data for the week which ended on Tuesday, April 4th. You can see that there is a time lag here, so we have to take this into account. We can see that the overall US dollar long positions have continued to decline as it happened in the week before as well, although the pace of decline in dollar longs has decreased. If we look at how other currencies are positioned versus the US dollar and versus other currencies, we can see that there was an increase in bearish position for the euro. I think before we were talking about the fact that the net short positions on the euro have become extremely small in comparison of what we were looking at during the last several years. Last week, we saw that the market players started to turn negative on the euro once again. And the market still has large short positions on the British pound and Japanese yen. These are the most heavy net shorts. Here, during the past week, these positions have contracted a bit, especially if you look at Japanese yen. But still, these are very sizable net shorts. And also there are net shorts on some of commodity currencies like New Zealand dollar and Canadian dollar. Australian dollar, on the other hand, is at the bullish territory here, and so is gold. Gold, you can see solid net long positions in this table, and there was a very sizable increase during the past week. So keep in mind this info as we will look at the charts. Firstly, I propose to have a look at the chart of the US dollar index, because sometimes when we study the currency pairs we trade, we forget about the general dynamics of American currency, the general trends which exist in the US dollar. And I think having a look at the US dollar index helps to analyze American currency better and to make better forecasts for the currency pairs. Probably better to start looking with the weekly chart. You can see here that the overall uptrend in the US dollar index still exists. The week before last, there was a bullish engulfing pattern, and the price managed to reverse up from support line. Support line actually goes back to May of 2016, and US dollar managed to reverse to the upside to trade currently above 101 area. However, we can see that there is a kind of consolidation phase. We see that the US dollar is consolidating within a wedge, and that we are now getting close to resistance, which is located at 101.50. This is resistance line, which is drawn through this year's high, and this would be the third point where this line will touch the current market price. So I think that the existence of this resistance line tells us that it might not be easy for the bulls to overcome this level. As for support levels, here we can say that support is located at the area of 100.50 lower, and the psychological level of 100.00 and around 99.20. So at the daily chart, maybe you can see that in greater detail. Here I have some moving averages, and currently the dollar index is testing 100-day moving average to the upside, and there is some scope to the upside, some further scope to the upside this week before they hit this resistance line, which goes from this year's high. And looking at this chart, it is reasonable to discuss the fundamental factors which are lying at the base of this movement of the American currency, and for us to have a better understanding of what is happening with the US dollar. All in all, we can say that the economic news for the greenback, which were released during the last week, were more negative than positive. American manufacturing growth slowed to 6-month low. US non-farm payrolls failed to impress the market. America added only 98,000 of new jobs in March versus the forecast of 174,000. But here, to be fair, we need to point out that at the same time, American unemployment rate declined from 4.7% to 4.5%, and this is a fairly good reading for the unemployment rate. And average earnings showed a stable growth of 0.2%. In fact, we can see now that inflation is the most important indicator in terms of the Federal Reserve's monetary policy. Earlier, the Fed was targeting labor markets really strong, and its policy actions depended on the state of American labor market. It happened because there were real problems. There was a huge decline in the number of jobs during the financial crisis of 2008, and from that time, we saw constant problems with non-farm payrolls, with unemployment rate. This is why the Federal Reserve had to improve the situation, had to help the economy, had to help American companies hire, and that's why they kept such an loose monetary policy, which included non-standard measures in form of quantitative easing. Now we see that the labor market has managed to come into a rather good shape, and the Fed has begun its tightening cycle in the rate of 2015. Now this cycle is continuing, and the pace of the rate hikes depends more on inflation than on the labor market, which is already rather well. As a result, we can see that non-farm payrolls doesn't have the impact on the US currency anymore, at least if we compare the current impact with what was a couple of years ago. Then the markets were trying to judge whether the Fed will do additional easing measures. Now we have a kind of different situation, and the fact that there was no slowdown in the US average earnings indicator did really send a positive signal for the greenback. So after initial decline on Friday, American currency managed to show a strong weekly close. And we can the conclusion we can draw from this information is that for now, despite the fact that the economic figures may not seem very bright, still they may be kind of enough for the Federal Reserve to continue with its plan of 2 or more rate hikes this year. Of course, it is very interesting how the Federal Reserve will comment on this recent developments, and we'll hear about that today as the Federal Reserve's chair Janet Yellen will speak on Monday. It will be late during the US trading session, so there is still time ahead of this. And also on Tuesday, there will be comments from FOMC member Kashkari. He will also address the public. So this is the insight from the Federal Reserve we may or may not get this week. I hope that some comments on the recent labor market data and the recent inflation data in the US will follow. So also the news from America were not only from this side. There were many political news. For example, House of Representatives Speaker Paul Ryan said that tax reform would take longer to accomplish than healthcare reform that actually failed in March. And of course, this was a source of concerns for the US dollar. We can see on the daily chart that there was a spike on Wednesday, and the market failed to close at the top of this spike on Wednesday. This happened because traders are concerned. They think that any hurdles to the tax reform are negative for the US dollar, as these hurdles may delay the Fed's rate hike. And in addition, the FOMC minutes on Wednesday showed that the Fed is going to trim its $4.5 trillion balance sheet into the end of this year or even earlier. And this was also interpreted as implying less need for the Fed's rate increases and hurt the US dollar on Wednesday. Still, the fact that after this spike on the daily chart, we saw no big sell-off of the American currency. On the other hand, during the following 2 days, the greenback managed to go higher and to close above Wednesday's high. Surely means that traders are not really concerned, but they still think that the situation is okay enough for the Federal Reserve to probably raise rates as planned. Also, there were political headlines from the meeting between Donald Trump and Chinese President Xi Jinping. And these headlines were positive. This is helping the US dollar a lot, as it seems that Trump is no longer aimed at calling China currency manipulator with great force as he was doing earlier. And it means that Trump's efforts to devalue the greenback, to make the greenback lower versus the currencies of America's trading partners, won't be probably as intense as they used to be. Also, we will get a block of the US statistics this week on Friday. There will be CPA data and also retail sales figures. So will be important to analyze these things as well in order to judge the further policy of the Federal Reserve. As a result, going back to the trend with the US dollar, I think the currency still has some opportunities to consolidate within this current wage formation. And I believe that there are needs for further bullish drivers for American currency before it will be able to break this resistance to the upside. So for now, I think that this week may come below this resistance line, and that we may see more of consolidation. Here is the general agenda. You may see that this week we'll get also many important data from other economies. There will be a lot of releases from the UK. British inflation figures on Tuesday. The speech of the Bank of England's Governor Mark Carney on Wednesday, and the UK labour market figures, which are due on Wednesday as well. In addition, there will be a meeting of Bank of Canada on Wednesday, and there is a small risk of significant change in the bank's current policy. This risk is small as economic performance of country and Canada's inflation figures have little changed from February. Canada's exports are still facing some challenges with competitiveness and protectionist rhetoric increases in the US. And a dovish stance of the bank will keep Canadian yields lower and Canadian currencies under pressure. Any hawkish statement can lead to the short-term appreciation of Canadian dollar. In the end of the week, also there will be a release of Canadian manufacturing sales and US inflation, which also will be important. Let's now probably switch to the charts. I greatly apologize for some noises we have here at the background, but regrettably they are in other area, so I just can't do anything with it. And I hope that the noise will stop and it doesn't derail my performance much. So let's look at a euro-dollar chart. We usually start with the weekly chart, and after the big decline, which was at the end of March, this big red candle engulfed several previous bullish candles. We can see that the single currency is going to the downside. Here is the daily chart, and we can draw a support line through the recent minimums of the euro dollar, and we will find out that the single currency is now trading below this support line. What is happening with the euro? Firstly, a main negative factor which contributed to this decline in the European currency was that the European Central Bank clearly still doesn't think that the rise in inflation is sustainable. Mario Draghi, the ECB president, said that he doesn't see the cause to deviate from the ECB's stated policy path, which includes bond buying at least until the end of the year, and record low rates until well after to stimulate inflation. Accounts of the central bank's March meeting showed that the regulator is rather pessimistic about the region's economic outlook, and as a result, the outlook for the euro has darkened. we expect that the single currency will be feeling the pressure from the ECB's dovish stance. And the fact that we are now below this trend line support is negative for the euro. It also contributes to the fact that we should focus on the downside targets. Other news which we released last week included an unexpected increase in German industrial production. However, French industrial activity, on the contrary, contracted, and so did Italian retail sales. So we can't even say that there are positive economic figures out of the euro area. If we look at the economic calendar for the upcoming days, this calendar includes German and European economic sentiment and industrial production on Tuesday. And on Friday, there will be a bank holiday in Germany. This is all to look at in Germany. So, and the euro area as well. So, once again, the idea is that the single currency is able to test lower levels in the coming days. Here you may see the red and blue lines. This is an indicator called pivot point multi-time frame. And if we look at the currency pair from the weekly perspective, I find that this weekly pivot and weekly support often gives a good idea of how that currency pair may be, and it gives us some good levels where we can place our targets. So you may see that the euro is trading below 106.18 level, which is the weekly pivot level, and it means that the bears are in control of the situation. Also, I point out to the fact that at 106.18 we have another resistance in form of 100-day moving average, and the one. While the currency pair is trading below the weekly pivot level, it is inclined to visit support levels, which are here in bright blue at 105.50, 105.09, and the last weekly support is located at 104.40. Of course, levels in the area of 105 should give the euro significant support. This is an important support area, so we have to take this fact into account while we are trading. But there is some scope for the euro to test lower levels. The political factor, the French presidential elections, which are going to take place in 2 weeks, for now represent more negative than positive element for the single currency, as the less time until the election, the more risks the market players see. Until this event is out of our calendar, probably the demand for the euro won't be very high, as traders who had seen some unexpected results of elections and referendums last year would likely prefer to remain on the cautious side here. I have read several forecasts today from big banks who think that actually a time is getting closer of a reversal in the euro dollar to the upside, and this will happen after the French election. If Emmanuel Macron wins this election, then there will be a relief rally in the single currency. And well, I tend to agree with this idea. I think that there should be a relief, and probably the single currency will make another attempt to overcome 109 mark and probably visit even higher levels. But if we are giving the short-term forecast, if we are looking at the perspective of the next days, if we are looking at this week until Friday and including Friday, then I would say that it is a more suitable time for holding euro short positions or some small bets that the euro will test lower levels. This idea is confirmed by technical picture, plus we should remember the US dollar index chart, and there we can see some scope for appreciation in the US currency, which is currently benefiting from increase in the markets uncertainty, in the market's risk aversion. We saw the spike in geopolitical tensions that helped the greenback appreciate versus their higher risk currencies, and versus euro it also acts this way, as I can feel from the fundamental picture. So euro is vulnerable for lower levels. If we look at the 4-hour chart, we can see that there is some divergence in indicators like MACD and stochastic, and from current levels the single currency may try to consolidate a bit to test resistance around 106.18 and maybe the next resistance, which is located at 106.57, before it continues its way to the upside. Still, the moving averages on the 4-hour chart are in the negative state. There is soon an intersection to be between the 50 period moving average and 200 period moving average, and this shows that some further downside potential exists for this currency pair. Let's now have a look at the British pound and the weekly chart of this pair. And well, what we can see from our first side, that there is a sideways dynamics in the British pound if we are looking at it on the weekly basis. The consolidation is taking place currently in kind of triangle, and currently the pair is trading in the area of 1.2390. This is close to the middle of this triangle. Let's get also the Ishimoku indicator to the chart, daily chart. Sideways trading, Ishimoku actually does only that there is support in the area of 1.2365. Here it is. So other factors which we can see here is that there is 200-day moving average located at 1.2635. This line is going down and is providing resistance for the currency somewhere around here. Also, we can see that on the daily chart, at the beginning of the last week, the pair has formed a lower high and now is closed on Friday firmly below the support levels of 100-day moving average and 50-day moving average. These lines are currently acting as resistance located around 1.2420, and below this level the pair should be vulnerable for a decline to the support line, which is currently located near 1.2150. Here we may also apply Fibonacci instruments to the chart in order to find further support levels. And we can see that the support level we were talking about, 1.2365, actually corresponds with the 50% Fibonacci retracement of the advance in pound which we witnessed in May. Further support located at 61.8% FIBO. It is located in the area of 1.23, and also we have 1.2216 here, while resistance is located above 1.2420, located at 1.2450. Here we can also draw a resistance line, and of course the picture is more difficult for the bulls than for the bears right now. If we look at fundamentals for the pair, we should point out that economic data out of the UK were disappointing. The UK manufacturing PMI came short of markets' expectations. UK industrial production figures declined, and the nation's trade deficit has widened. Friday's US labor market report was a bit controversial with soggy NFP headline and jobless rate increase, but still jobless rate decrease, but still the markets after all viewed it as more positive than negative. So next week we will receive This week we will receive UK inflation figures on Tuesday and labor market data on Wednesday. Upbeat economic releases will allow the pound to recover to some better levels. In case of disappointing data, selling of the pound will intensify, and we know that the US data will be of importance here as well. As the official Brexit process is finally underway, market awaits a formal response from the European Union on the terms of its separation with the UK. And as we don't expect many news about Brexit in the coming days, the pound's value will depend on the UK economic fundamentals. So the idea is that as there will probably be nothing from the Brexit issue in the coming days, then UK economic fundamentals will be the main driver of the pair. If they remain negative, if they remain weak, when levels of 1.23 and 1.2216 are quite attainable. If the fundamentals from the UK are good and there is some disappointment in the US data, then the bulls will try to test higher levels, try to test resistance. But at this point, the downside scenario looks extremely more likely, as I can put this for this pair. We are moving to dollar yen. We are at the weekly chart. Yeah, at the weekly chart also. I hope that these bright levels doesn't prevent you from having a look at this yellow line. This line is 200-week moving average, and you can see that for 2 weeks in a row, this line, which is located at 110.25, saved dollar yen from further declines. And this is why we should respect this support level greatly. Let's now have a look at the daily chart. Here I also have this indicator of the daily pivot levels, and you can see that the pair started this week above the weekly pivot mark located at 110.90, and the resistance levels we'll focus on are located at 111.72 and 112.39, together with 113.19. All in all, I think the level of 111.70 is very important, because in this area we find the lows of February, which were initially broken. Then there was an attempt to get higher, to return higher, but then the pair once again dived down. Geopolitical tension limit the US dollar's ability to increase versus Japanese yen. If we look at the economic data from Japan, they weren't particularly bright. The Bank of Japan's Tenkan quarterly business survey showed that the index for big manufacturers' sentiment came in at 12 in March, failing to match the forecast of 14. At the same time, this geopolitical tension, the US missile strikes at an air base in Syria provoked an increase in the market's risk aversion and consequently demand for the yen as a safe haven. US labor market figures were mixed and didn't provide a big boost for the US dollar here, but still helped the US currency to stay above the support line. So here we have a kind of controversial situation. On the one hand, the US dollar is surely stronger than Japanese yen. On the other hand, geopolitical tensions act as a bit of negative factor and don't let the greenback to get here in full force. So the upside potential is surely limited. I wouldn't expect the greenback to get much above 112.40, and 111.70 is also a hurdle for the US dollar. The pair is consolidating, and although upside levels are more likely, still there is not much to go on the upside. I also remember that there was an Ishimoku cloud important here at the weekly chart. Let's have a look at it. Probably I'll make the cloud a bit brighter so that you could see it better. Here it is, and we'll get rid of the pivot indicator. Now we'll see better the weekly picture. And here you can see that at 111.36 there is the top of the negative Ishimoku cloud. The pair has already entered this cloud, and this was surely a negative thing for the US currency versus Japanese yen. There was a lower high formed on the weekly chart, and the pair fell below its minimums. Once again, the 200-week moving average represents a good support, and if there is a close of the weekly candle or a daily candle below the level of 110.30, 110.20 will turn more negative on dollar yen, and we will have inside the 50-day moving average, which is located at 108.24. For now, the picture looks better. There is potential for the upside, although you can see here as well with the daily Shimoku cloud this time that this potential is limited by levels which are above 113 mark. Although the fundamental picture for the pair is not very interesting as we have very little on the Japanese side of things. So the main things fundamentally to focus on will be data from the United States, statements of the Federal Reserve's officials, and also the market's risk sentiment, which may increase demand for the yen. So be attentive. Focus on these resistance and support levels in your trading. Finally, we'll have a look at Australian dollar. Here with the break to the downside, the pair continues to get lower on the market's negative risk sentiment. If we take Fibonacci levels of the recent biggest move to the upside, we can see that the pair hasn't retraced 50% of its move to the upside yet. This 50% level is located at 0.7450, and the next level, the next support will be at 0.7380. All in all, as the pair has penetrated the daily support levels to the downside, the picture has surely become worse. And also last week the pair closed below the 50-week moving average, which is a pretty negative signal, and this reinforces the odds that the pair will travel to 0.7450 and probably 0.7415, where we have 100-week moving average. Let's also open the chart of the US dollar versus Canadian dollar. Firstly, the weekly chart. Here we can see that the pair is moving very slowly. We don't see big momentum here. The consolidation around 1.3370 continues to take place. And well, at the daily chart, we can see that significant support is located in the area of 1. All in all, the market is waiting for the meeting of the Bank of Canada, and well, I think that the more dovish odds are likely. So the decline of dollar Canadian dollar towards 1.3288 will likely meet some meet some support, and some new bullish players may appear here. And well, we may have a look at gold as well, spot gold. And the weekly chart, you can see that gold is pressed by the weekly moving averages. Last week, the asset tested highs in the area of 1270, but then declined and failed to close above the 50-week moving average. This is the main hurdle on the upside. On the downside, support is located at 1235.60. And on the daily chart, we can see that this chart provides us with some more support levels around 1242 and then at 1234. These are the levels we should focus on for gold in the near term. So this is what I wanted to present today. Let's now run over everything, and summarize the picture for the main currency pair. We can see that the US dollar index is feeling rather good. It has some scope to the upside. We target levels around 101.50 for the US dollar index, where the asset will face resistance. And despite the current bullish bias, we think that the outlook for the US currency will be more consolidative. So it is a bit too early to expect the big break to the upside in the US dollar index. In the meantime, American currency feels rather good versus the euro and the British pound. The euro is hurt by the dovish stance of the European Central Bank and is vulnerable for declines to levels at 105.50 and 105.10. 105 should offer significant support for the single currency. As for the British pound, it's made a negative close on Friday and below support at 1.2365. We will target levels at 1.23 and 1.22. In the absence of fresh news about Brexit, here everything will depend on the fundamental factors from the UK and the United States. Dollar yen has some scope for the upside, although the pair's ability to gain should be limited by levels around 112.70. Below that, there is a significant hurdle located at 111.70. Good support lies at 200-week moving average at 110.30, and if there is a break of this level, then we'll put short positions with target around 108.34. This is now a weekly moving average. Currencies like Australian dollar feel vulnerable versus the greenback, and for Australian dollar we target levels at 0.7450 and probably even 0.7415. While gold has a serious obstacle on the upside at 1258 and may test lower levels this week at 1242 and 1234. This is what I wanted to tell you today. I apologize for some background noises. I hope that they didn't derail my presentation much. I wish you success in your trading and will be very happy to see you next week at this webinar about the outlook for Forex measures. And goodbye, see you next week.